Central banks are the most powerful institutions you were never taught to question. They don't win elections. They don't campaign. Most people can't even explain what they do. Yet they control the price of your money, the cost of your debt, and the value of everything you earn and save. They can create wealth with a keystroke or erase it just as quietly. And the strangest part, they don't really answer to you. This is the story of how central banks came to dominate modern finance, not as neutral referees, but as active players in a system they helped design. A story of hidden power, engineered stability, and why your financial life is shaped by decisions made far beyond your reach. Let's start in 1694. England was broke. War with France had drained the treasury. So the government made a deal with a group of wealthy merchants. Lend us £1.2 million and we'll give you the exclusive right to form a bank. That bank, the Bank of England, would issue paper money backed by government debt. This wasn't created to serve citizens. It was built to fund the state and profit from it. That was the original purpose of a central bank, not stability but war finance. And the model spread. By the 19th century, central banks across Europe followed the same pattern. They issued currency, managed reserves, and acted as lenders of last resort, gaining enormous influence with little democratic oversight. The United States resisted longer. Americans distrusted centralized financial power. The first and second banks of the U.S. were dismantled after fierce political battles. For decades, America had no central bank, and the result was chaos. Private currencies. Speculative bubbles, repeated financial panics. Then came 1907, a crisis so severe that J.P. Morgan personally organized a bailout. The lesson was clear: the system needed a backstop. In 1913, the Federal Reserve was created. It was sold as a decentralized network to stabilize the economy. In reality, it became a central authority controlling interest rates, credit, and money supply. And here's the uncomfortable truth: the Federal Reserve isn't a normal government agency. Its board is appointed by elected officials, but its regional banks are privately owned. It doesn't rely on taxes. It funds itself through interest on government debt and fees charged to banks. It operates independently, meaning voters have no direct control over decisions that affect their savings, loans, and cost of living. Officially, the Fed exists to maintain stable prices and full employment. Unofficially, its actions consistently favor the financial system itself. You saw it in 2008. The Fed didn't just cut interest rates, it printed trillions of dollars, it bailout out banks, it absorbed toxic assets, it propped up markets deemed too big to fail. Then it happened again in 2020, markets crashed. Within weeks, central banks flooded the system with liquidity, stocks rebounded, asset prices exploded, billionaires grew richer. Meanwhile, millions lost jobs, small businesses collapsed, renters faced eviction. What was saved wasn't the economy, it was the system. This is the core reality of central banking. When things break, central banks protect markets first, asset holders first, institutions first. They shape the economy by deciding who gets cheap money and who pays for it. When rates are low, borrowing explodes and asset prices rise. Those who own stocks and real estate benefit. When rates rise, debt becomes painful. Mortgages, credit cards, and loans squeeze the working class. Saving is punished, debt is rewarded, and this isn't accidental. Since 2008, central banks normalized policies once considered extreme: quantitative easing, permanent low rates, trillions created digitally to buy government bonds and corporate debt. The result: housing became unaffordable, markets detached from wages, living costs rose while savings earned nothing. Inflation quietly ate purchasing power. Most people blamed politicians or bad luck, not the invisible force controlling the price of money. Here's the hard truth: the modern system is designed to keep you moving, consuming, borrowing, not free. Central banks smooth crises by inflating asset prices and expanding debt. They stabilize markets, not lives. And they do it using language so technical that few question it. Interest rates aren't neutral. Inflation isn't random. Money isn't apolitical. Every decision distorts incentives. It reshapes risk. It creates bubbles, then crashes. And worst of all, it removes agency. Most people never realize their student loan rate, rent, retirement, and savings are downstream of meetings they'll never attend, run by people they'll never vote for. So who do central banks serve? Officially, everyone. In practice, the system that created them: banks, markets, governments drowning in debt. A financial class that benefits most from asset inflation. This isn't a conspiracy, it's structure, a revolving door between central banks and financial institutions, a language barrier that keeps outsiders confused, but once you see it, you can't unsee it. Financial education isn't just about investing, it's about understanding power, knowing that stability is often engineered and temporary. You can't fight the system directly, but you can reduce your exposure to it. Deleverage. Diversify, own things that can't be printed, build skills that survive cycles. Question narratives that promise safety through debt, because when the next crisis comes, and it will, central banks will do what they always do. Protect the system. It's up to you to protect yourself.